Gold spikes upwards 30% in a number of weeks. Bitcoin doubles in a short period of time. A stock everyone's talking about explodes to the upside, and you're about to bet everything on it. Don't do it. This feeling has destroyed more portfolios than any market crash. Today, I'm going to break down the 5 psychological traps that make investors go all in. Let me tell you about an investor I know. Let's call him Alex. He saw a stock go up 40 to 50% in 1 month. Everyone around him was making lots of money. His friends were talking about it. Felt like the opportunity of a lifetime. It's a new technology. He had to have it. Everyone had to have it. He went all in with some savings, and then it didn't work out. This story is as old as time, believe me. Well, there's a famous story about Sir Isaac Newton, a very famous person back in the 1700s. So taking a look at this chart, you can see the South Sea Shipping Company, which essentially went up tenfold between 1718 and 1721. Isaac Newton entered early in 1720 or so, and he doubled or quadrupled his money in just a couple years. And he left and he exited happy. After that, his friends started talking about how much money they were making in the South Sea Shipping Company, and he couldn't take it anymore, and he got all in with a lot. Invariably, just like always happens in bubbles, or nearly always happens in bubbles, the other side of that parabola came to light and he lost nearly his whole fortune. And this was a lot of money back in 1721. About 20,000 British pounds is what I read. So just a lot of money. So what happens during this process, particularly in the downside, is that you go through the 5 stages of grief until you finally reach acceptance. The problem is that you don't have to go through all this. And we're here to help you make sure that you don't. We want to help you avoid these mistakes. A lot of us have made these mistakes. I've made some of these mistakes. And if we can help you to avoid some of these mistakes, I think we're doing a good job. I've been in this business a long time, basically almost 27 years now. And I've made some of these mistakes. I've been through this feeling. So it helps me help people more because I've been through it. I can see and understand and empathize with the different psychological traps that people can get in because I've made the mistakes. Let us help you if we can avoid some of these mistakes. It's not worth it. Trust me, it is not worth it to go all in. So Isaac Newton, Alex, the friend I talked about earlier, and even myself, we're not unique. The pattern repeats across every market cycle. Here's why. Everyone goes through these feelings. It's human nature. Investing is inherently emotional, even when you try your hardest not to be emotionally. It takes years, sometimes many painful experiences like I talked about, and a lot of patience to overcome. I would say that for a lot of people, it's not even worth trying to overcome these psychological hangups. For many people that start early in life and index and low-cost funds and stay there for 70, 80 years, I think that can work as long as you don't panic out in the invariable bear markets. For people that are tactical or more active, if you're going to be hands-on, you're going to have to start to recognize these emotional hangups and you work your way through them because the market is in an infinite environment and it's going to find its best way to try to trip you up with your own psychological hangups. It's been said many times that the market is an expensive place to find out who you are. But if you do try, it's going to try to find your weaknesses, believe me. For a lot of people, it's not worth it. A lot of people that have a career and a regular job don't go into the market day trading or don't go all in trying to make a quick buck because when it goes wrong, and it will go wrong sometimes, it's just not going to be worth it. It isn't. So what are some of the ways around that? So here's a couple traps. So this is why people get involved in all-in type mentality thinking. And this is why we try to help them avoid this. So the first trap really is FOMO, or fear of missing out. And call this the gateway drug. Fear of missing out turns rational people into gamblers. Everyone needs to be in the pool. It's no fun watching all your friends and family in the pool having a great time, enjoying a barbecue and just having a really good time, and you're sitting out there bored with your arms crossed. Everyone wants to be in. So this is a tendency. It's a normal tendency. And logic disappears during this time, particularly at the height of a bubble. A few examples would be crypto market, Bitcoin, and other meme coins, meme stocks, gold and silver rallies even recently. There's been some froth and some all-in thinking there. And even though I think gold and silver markets going higher, you got to be careful about this FOMO or all-in feeling. And even tech stocks back in 1999. I was in the business back then and everyone had to be in tech stocks. Some of those stocks turned out to be very good long-term, but a lot of them went away. The second trap is the superiority illusion. Nobody thinks they're average. Nobody invests to be average. Everyone trying to beat everyone else means that sometimes you're going to be the loser. You can't be number one all the time. Everyone thinks they can be, but the law of averages says that sometimes you're going to be on the losing end. None of us want to think that we're going to go all in on a stock or an idea and be on the losing side, but believe me, it happens. I know I've seen it happen many times, and it's happened to me, as I described earlier. So be careful. That's why long-term investing works. That's why long-term indexing works, and there's nothing wrong with that if you're going to do that over decades. I'm not saying all this stuff to dissuade you from trying if that's what you really want to do. Just bear in mind that it's going to be a process and it's not going to be easy. You're going to have to pay the price to get to the other side of all of that. The third trap is survivorship bias. You see the Tesla millionaire on YouTube. You see all kinds of people that went all in that have made millions or hundreds of millions even. What you don't see is the losers. You see the one winner, but you don't see the 100 people that lost when they went all in on something and it didn't work out. There's nothing better than going all in and having it go to the moon. The richest people in the world did that. Bill Gates, Jeff Bezos, etc. And they also went all in on their own ideas of businesses. And so that's not to say don't try. Obviously, starting a business is a great idea. We've said that many times. And if you haven't heard us say that, I'll say it now. Entrepreneurship is a great idea. You go all in on something and it works, great. If you go all in on a stock or an idea, and it's not your company, it could still work out, but the likelihood is that it won't. And the likelihood that you're going to be the one winner that everyone looks up to and is envious of is not that high. So be very, very careful. The graveyard is full of failed next big things like WeWork, Theranos, collapsed altcoins, all kinds of things. The list goes on, and there'll be a lot more in the future. A very high percentage of all-in bets fail. And the interesting thing about all-in bets, if you even look at companies like Apple or Microsoft, because if you go back to the 90s, Apple almost went bankrupt. You could be down 60, 70, or 80% on your all-in bet early on, and it takes a heck of a lot of faith to hold on to the other side. So how many people invested in Apple early and didn't even get to the other side because they had to get out because the pain was too high or they had margin debt or something like that? So don't put yourself in that position. Again, the underlying moral of the story is that it just isn't worth it overall. The fourth trap is this time is different delusion. Every bubble has a narrative that sounds rational until it is not rational. Here's some historical examples. Housing bubbles, tech bubbles, Nifty 50 in the 70s, maybe AI stocks now. Who knows? That's a debate. These are just some examples of some things that have been all-in bets or the next best thing. New era thinking always precedes corrections, but timing is near impossible. So AI stocks, maybe they go up fourfold from here and then crash. All-in bets just require so much psychological investment, and they take so much away from you in terms of peace and tranquility that they're probably not worth it. It took me years to realize that. It takes people years to realize that. Professionals in general are not going to risk more than a couple percent per idea overall, just to give you an idea. Now, that doesn't mean that they're only putting 2% into any one idea. That means that they're probably not going to risk more than 2% on any one idea. So they might put 10% of their portfolio into an idea, but if they have a 20% stop on that idea, they're going to risk 20% of 10% or 2% of their portfolio. Just compare that to a 100% all-in bet on an idea. Again, it might work, but professionals don't do that, and you really shouldn't do that either. So the fifth trap that I want to talk about is dopamine hijacking. Rising prices literally rewire your brain like gambling. It feels great. You receive dopamine. Dopamine receptors are happy. It's a confirmation bias loop. It feels good. Prices keep going up. It feels better. When that reverses and the dopamine isn't coming anymore, the brain kind of freezes and you start to go through the 5 stages of grief. This is what we're trying to help you avoid. What you want to do in your own investment is reach a kind of a fluid state where no one idea can destroy you, where no one idea can stop you in your tracks. You have to be able to move fluidly and make fluid decisions. It's just better psychologically, and it's going to be better financially too. When one idea doesn't have to work for your success, you can be much more flexible and your probability of success is much higher. Problem with down moves and an all-in idea is that every dip becomes personal. It's like a personal attack, and every little blip upwards feels like validation about your first idea. Just don't do it. It just isn't worth it. It's not worth it to walk up to the roulette table and put everything on black or red, even if it works. Nobody loves success like the public, right? And we're only going to see the times that it works. There's lots of times that people went into roulette, put everything on red or black, and it didn't work. Well, you're not going to see those stories. So the amount of stress and anxiety that produces is just not worth it. Not all in bets are equal. Here's what separates legendary bets from losses. Let's talk about some winners and what made them different. Michael Burry, 2008. The Big Short. Years and years of research Michael put into betting against this, the mortgage bubble, shorting the mortgage bubble. It's in CDSs and credit default swaps. If you saw that movie, you see that he put years of research into it. He had absolute conviction in his data. He had a hedge position as well, and yet he still lost all of his peace and tranquility and his clients. You can see in the movie, he got calls. People were upset. The positions went against him, and he nearly had to liquidate at the exact wrong time. That is what an all-in bet will do. Now, that story had a good ending. Everyone loves a happy ending. Not all stories have a happy ending. He could have easily been liquidated out or margined out at the very worst time. But Michael Burry did his research. He made a big bet. He was a professional before he made that big bet. He knew what it entailed, and yet it still ruined him. So you've got to decide for yourself whether it's worth it. I think it isn't. Warren Buffett's big bets. He's done deep fundamental analysis, got lots of patience. He doesn't fall victim to FOMO. Famously, I seem to remember that he made a big investment in Goldman Sachs back at the bottom of the last great financial crisis. But Warren Buffett can do things that you can't do. For instance, he gets preferential treatment on his investments. He sold puts on the market. He had this deal with Goldman Sachs where he got preferential treatment, and I believe he got some convertible stock, meaning that he essentially made a loan to Goldman Sachs, from what I remember, and was able to convert to stock if favorable. So big investors can get terms that you can't get. That's ultimately the bottom line. Here's some losers, and here's the common thread. Tech millionaires in 1999 and 2000. I remember this well. I had some clients that were involved in JDS Uniphase and in Nortel. I remember one in particular back then had maybe $3 or $4 million in Nortel options, and they went to zero. Long story short, they went to zero over a couple years. And I got to see firsthand early in the business the psychological trap of what it looks like, seeing your own net worth go from like $3 or $4 million to 3 million, 2 million, 1 million, always thinking there's going to be a big bounce, and there never was, all the way down to zero, and going through the 5 stages of grief. There's a lot of tech millionaires that lost everything back then. A lot of these stocks went to zero. Averaging down disasters is normally not a good idea either. That's confusing conviction with stubbornness. Again, I've seen this in myself. I've seen this in others. It's a really bad habit to break. You're sure you're right about something, you keep averaging down. Ultimately, some piece of news comes out that you didn't expect, and the stock goes lower and lower. Eventually, you just reach this acceptance stage of the 5 stages of grief. That's not what you want to have happen to you, and we're here to help you. Here's a key bottom line and another moral of the story. Winners have an asymmetric edge, meaning they risk a little if they lose, and they win a lot if they're right. Losers have asymmetric risk, meaning everything has to go right for them to win big, but then there's a high probability of losing everything. So that's the big difference. And it takes years to understand the difference, and years and lots of patience and some mistakes to get there. If we can help just a couple of people avoid that, I think it would feel good that we're doing some good. Here's an all-in test. Before you ever consider concentrating your portfolio, run this test, or think about this next time you think about going all in. First question, do I have a genuine edge? Is your edge what everyone's talking about? If your edge is that AI is going to change the world, for instance, you're already too late to go all in. The people that made big money and have already made big money on AI got in before these companies were even public. Doesn't mean you can't make money in AI, it just means you shouldn't go all in, because you don't have the edge perhaps that you think you do. Question 2, what's my worst case scenario? If you lose the whole investment, are you still going to be okay? Risk tolerance isn't what you think you can handle. It's what you can actually afford to lose without worrying too much. So think about that. Third question, am I making this decision calmly, or am I making it emotionally? Here are some red flags: urgency, fear of missing out, comparing to what others have made in the same idea. Don't do that. The best investments are boring decisions, not exciting ones. Fourth question, have I sought an outside perspective? Think about that. Talk to somebody who will tell you why you're a genius. Can't talk with, in a group about everyone that's in the same stock and expect to receive devil's advocate type feedback. That's not to say that everyone else is more smart than you or smarter than you, but it helps to get an objective opinion. We could perhaps be that objective opinion for you. So, in closing, here are some antidotes to all-in thinking that can help you avoid some of these mistakes. Position sizing rules. As I mentioned earlier, don't risk more than like 2, maybe 3% on a single investment. That way you can get out, take your stop, and just move on to the next idea. It's no big deal. Investing is a process, a long grinding process, whether you're accumulating annual gains in an index fund or accumulating good ideas. If you have an edge and you can apply it over thousands of times, over many years, you're going to make money. What you don't want to be is that gambler that goes all in on a red. Diversification isn't boring, it's just smart. So diversify. If you're a do-it-yourself investor, you might have 10 or 15 ideas, not just one. If you're an indexer, it's a little bit different. You're going to be in hundreds of things at once. But if you're an investor, private investor doing your own thing, you should have at least 10 or 15 ideas. You shouldn't risk more than a couple % per idea. And you should keep applying the same logic and edge over hundreds and thousands of ideas over many years. It's a grind versus an overnight windfall. Just remember that. If you're over-concentrated, hedge. Options can help here. Inverse positions essentially are portfolio insurance. You never know when the worst can happen, and this can help you from freezing at that critical moment. Build systems, not emotions. Have some rules about stops or rebalancing or maximum exposure, that type of thing. Again, it takes years and years for many professionals to reach these levels. If you listen to some of these tips, you can perhaps cut some of those years away. So in closing, FOMO makes you feel like you're missing out, but discipline and patience have created more lasting wealth than any single bet in history. The market will always give you another chance, but only if you live to see another day. Financially, I'm speaking. Look, I've got the same exact conversations with clients almost every single day. Someone calls me convinced they've found the next big thing, ready to liquidate everything. And my job is not just to manage portfolios, but be the voice of reason. There's a lot of psychology in what we do here. Now, if a person wants to actually do that and go all in, ultimately, I'm not going to stop them because it's their money overall. But I'm going to try to tell them all of the pitfalls that they might see and help them perhaps establish some rules that can help them avoid the biggest losses and the biggest pitfalls that I've just described above. If you're wrestling with some of these things right now, if you're feeling the pull to go all in on something, I want to offer you something. Just reach out to us. Book a free 15-minute consultation, no sales pitch, no obligation, just a conversation with somebody that's talked hundreds of investors through this exact moment, a conversation with somebody that's been through this exact same thing in my life. Sometimes all you need is an outside perspective from somebody that's seen how this whole thing plays out. The link is in the description below. Let's talk before you make a decision you can't undo. Please do reach out to us so that we can have a brief chat. Also, please subscribe to this channel, like this video, click the little bell icon so you get notifications. We feel honored and privileged that you tune into these things, and we're just trying to share what a lifetime of experience has taught us so that we can help you not make some of the same mistakes. I'm Mike Preston at New Harbor Financial. Thanks for watching.